In this video, we'll be covering some key concepts relating to assets. Assets are similar to expenses in that they're typically a cash outflow in exchange for a future economic benefit. What sets apart assets from expenses is where the economic benefit of an expense is usually limited to within the next 12 months, such as utility bills and wages. The economic benefits of an asset is usually longer than 12 months, such as a company car or the cost of setting up a website. The purchase of an asset is not recorded in your profit and loss statement, but instead sits in your balance sheet, where it is depreciated over its useful life. Think of depreciation as spreading out the cost of your assets over the period during which you expect to get an economic benefit from the asset. For example, when you purchase a car for $10,000 and you expect this car to be used in your business for around 5 years, the $10,000 is recorded as an asset, while $2,000 is depreciated over each of the 5 years to spread out the cost of enjoying the economic benefit of the car. You may also expect to make some money on the disposal of your asset after its useful life. If this is the case, your asset will not fully depreciate during the period it is held, but only depreciate the difference between the purchase price and the salvage value. Depreciation is important because it is included in your profit and loss and goes towards the calculation of your tax liability. For capital-intensive businesses, such as those requiring expensive machinery, depreciation in the earlier years will often mitigate all tax, even though the business may be cash flow positive. When forecasting assets, there are two things to consider. Firstly, like expenses, always think about how the asset is supporting your revenue growth. Some assets are semi-variable in nature, meaning the greater your revenue, the more assets are required to support your business. Think about at which point will you need more assets to support your growth. Secondly, since assets tend to be significant in value, think about how you're going to fund the asset. Do you fund it through debt, whether it is through your existing debt facility or setting up a new one? Or do you use the cash reserves of the business, which means you'll need to save up for a period of time? Alternatively, the business owner can fund it if neither of the other two options are available. In the next video, we'll take a look at how all of these are dealt with in the model. Thanks for watching.